Okay, it's 11 o'clock. We're going to get going. All new format. Well, it's not it's very sort of similar format, but different presenting software. Um, I'm going to hand over to Andrew really to get us going. So we're going to talk about what happened over the course of 2024. I'm going to try and run through the entire sector. So we'll do it quite quickly. But if you do have any questions, please do chuck them in the chat box. So over to you, Andrew.
Lovely. Thank you very much, James, and welcome everybody. Happy New Year. As James said, we're going to have a run through exactly what happened last year and see what lessons we can learn from that to take forward. So let's begin with an overview of the sector and how it did. And I think actually last year it was easy to become a bit too gloomy because we were all talking about winding up and contraction of the sector and wide discounts and problems with cost disclosure. And I think against that background, it was quite easy to think actually that we'd all been losing money. But in fact, it was a positive year generally. And the investment company sector as a whole was up 7.7%. That's using the FTSE 350 closed-end investments index. And that was ahead of the FTSE 100 index. So that's the good news. The less good news is that it was well behind actually the US indices, which were really driving global markets last year. And those were way ahead of most other things. So the S&P 500 was up 23.8%, for example. But generally across the board, as you'll see as we move through the sectors, actually nearly all of the equity sectors did quite well last year. So we shouldn't be too grumpy about it. So the biggest sector, of course, of all is the global sector, which actually did very well. So plus 19% overall. So quite nice returns from the big trusts that many people will own. And you'll see at the very top there, Manchester and London, which is really, I think, a bit misclassified in this sector because it's really a tech trust. It's really an AI focused trust. It's got very big concentrated holdings in that realm. But that nevertheless produced a fantastic return of 53% over the year. You can see all of the tables here are ranked by 1 year NAV returns. So Manchester and London at the top. And it's really great to see behind that Scottish Mortgage, because Baillie Gifford, I think, have been really bashed as a growth house over the last few years. And it's great to see them coming back to form. And we'll see that a number of Baillie Gifford trusts have done much better over the last 12 months. So great to see Scottish Mortgage there. And to my mind, it's also very good indeed to see both F&C Investment Trust and Alliance Witan actually near the top of this table, because those are both very important trusts as long-term savings vehicles. And I think as well, they're both in the FTSE 100. They're both important representatives of the sector. So really good to see those up there. If we're looking at the negative side of the balance sheet, there are some trusts that haven't done so well. If I could just go back to those actually. So KPC, the Keystone Positive Change, that's being wound up. That's at the very bottom here, only up 1.6% last year. Lindsell Train has been disappointing, and that's been a terrible example actually of a trust that's derated. So actually, if you look at Lindsell Train's 3-year NAV return, it's more or less flat, but the 3-year share price return is down 10%. And that was a trust that used to be on a premium rating and it's derated massively. So that's something to watch out for. Okay, we'll move on to global equity income. Again, quite a good return here, 13.5%. We can ignore the one at the top here, British and American, that's a tiny one. JP Morgan Global Growth and Income is, I think, the outstanding feature here. Very popular trust, which does have a flexible mandate, which means it doesn't have to invest in everything producing a high income. So it's actually got quite a lot of growth in the portfolio, which has done very well for it. And it's a great example of a successful trust in the sector that has expanded. It's grown its assets over the year from about 2 billion to 2.9 billion, and it stands on a premium rating. So again, amidst all of the talk about discounts and winding up, there are many successful trusts around, and I think that one is widely owned, so that's good to see. I think the less good one here is probably Henderson International Income, where the NAV growth over the year was only 5.4%. I mean, I think again it's quite easy to criticize the management when this happens, but this trust is positioned very much as a cautious trust. It's meant to be conservative, and it doesn't have those big growth stocks. So for that reason, I think it may thrive in slightly different circumstances. So I wouldn't be too critical of the management. It's just that's what you're buying there. You're not buying a go-go growth trust. And of course, last year, it was really growth that was driving these markets. Okay, we'll move on again. So the next one is global smaller companies. There's not too much here, but overall returns were okay, 5% or so. I think that's what we'd expect. We know it was big companies that were really driving the markets last year. It was those massive US tech stocks. Returns here were okay. Herald at the top. And of course, we've got to talk about that one because that's one of the 7 trusts that are under attack from Saba, who have requisitioned meetings to basically sack the management and suggest alternatives, including themselves. Now, Herald have announced their meeting is coming on 22nd of January. So that's the first one of these. And it'll be really interesting to see how that plays out. Herald have rebuffed the approach from Saba very strongly, said it has no merit. It's obviously up to shareholders to cast their votes and give their opinions. So we'll see what happens there. In the meantime, Herald shares have obviously narrowed their discount. They've come right into a very narrow discount of 1.8%. And the same applies to Edinburgh Worldwide, which is also under attack there. So this was okay. I haven't got too much more to say about that sector at the present time. The next one is global emerging markets, up about 10%. So again, quite decent actually. I think here something slightly different happened in that, and I found this over the years actually, it's been quite difficult to identify a really consistent emerging markets performer that's ahead of the pack because it just seems to change according to the market cycle. And that's happened again, I think. We've seen a bit of rotation here. So a couple of the trusts that actually weren't doing so well before, for example, Fidelity Emerging Markets and Bearing Emerging EMEA, they've come up in the rankings. And a couple of the ones that we'd relied on before, like BlackRock Frontiers and Mobius Investment Trust, have slipped down a bit. So I think there's been a little bit of rotation. I would just note, though, that Ashoka White Emerging Markets did have another good year. That's up 15%. That doesn't yet have a 3-year track record, but it's very promising, and I do like that trust. It's that was one of the last of the new issues that we had back in the midst of time, and it's actually had a very good start. So that's good to see. I do think looking forward, there's a great deal of uncertainty about emerging markets. Obviously, Trump and the tariffs is a big question here. So we'll have to see how it plays out. And I'll just mention the rather curious position of these 2 trusts, the Barings Emerging EMEA Opportunities and the JP Morgan Emerging EMEA Opportunities. Now, those are odd. And we do see the JP Morgan one on the list of risers and fallers almost every month. And that's because this was JP Morgan Russian securities. And of course, with hopes for a resolution to the Russia-Ukraine war, there are hopes that those assets, which it still owns, which are frozen, might come back into some kind of market environment where it can realize some value. But back in 2022, that trust did have about almost 50% of its assets in Russia. And in the case of the Barings Trust, it was more like 30%, although it did sell some actually before the war broke out. And so there's potential recovery to come there, which is why we've seen some quite odd valuations here. And the JP Morgan Trust is on a mammoth premium to NAV as a result. It looks like, excuse me, that looks slightly out of line with the Baring one. So anyway, I think you have got to be cautious about that. It's very hard to understand exactly what's going to happen with those. Okay, I think it's time to hand over to you now, James.
So flexible investment is obviously incorporating equities and also bonds and private equity and any other thing you want to put in there. So it's a multi-asset type investing approach. Castle Nor is a bit unusual fund. Some of these are. It's run by the same team as Aurora, what we're going to talk about in a minute. It bid for Dignity, the funeral services company. and got that revalued in the process, and that's what was the big driver of its NAV rise over the year, and that's really quite impressive. And then next behind that, we've got Tetragon, which I know Andrew's talked about on our show before. Actually, I think when this shot up, so it has a stake in an infrastructure investment manager called Equitix, and the press were speculating that this is going to be sold. Don't think we've actually seen an announcement that this has happened yet, so one thing still to watch out for. But as Andrew said, it's not one that we'd probably recommend because of this odd voting structure, which means that you're at the mercy of what the management wants to do with it. And speaking of which, the company with the non-voting shares, Hanson Investment Trust, also did relatively well. It's got a stake in a thing called Ocean Wilson's. In turn, that's got a stake in, or did have a stake in, a Brazilian shipping company called Wilson and Sons, and that's been sold. So that helped that get revalued over the course of the year. But that discount's still very wide because, again, you've got no control over what happens to your investments. I think the encouraging one here is McHattie, because this has been a bit of a problem child for a long time. And it went to a new manager with a slightly different approach, and they seem to be doing a relatively good job. So it's going to be interesting to see how that pans out in the future. And obviously, we love our Caledonia, as you know, and also RipCap. At the other end of the table, we've got a whole raft of funds that are just sort of giving up, really. So UIL has decided it's going to wind down, and it's already done some trades on the back of that. And that actually damaged the NAV. And then we've also got Aberdeen Diversified and Growth and JP Morgan Corporate Assets winding down as well. So that's it on that one. So if we look at the next sector, it's UK. Here we have this endless sort of debate between value and growth. I do think there was signs really that value was starting to work this year, especially in markets that weren't dominated by the big AI mega cap type things like the UK. And that kind of plays through into Fidelity Special Values numbers. But it's encouraging, as Andrew said already, that the Bailey Gifford funds are also perking up a bit, having had a difficult period. So UK Growth Trust there in the top. Small cap, if you had small cap exposure in your all cap funds, that was helpful, as long as it wasn't AIM. But some of the funds that have been suffering here, sorry for the sign, have really struggled with this. So Henderson Opportunities is one of those, and it's another one of the Saba targets. The board came back and said, actually, we've decided that it's not really working, and we're going to give you the money back or offer you a rollover, and we expect to see that announced quite shortly. And as for me, the surprise at the bottom of the table here is it was the Aurora UK Alpha Fund, because this is the fund that, on the back of reasonably good performance before, absorbed Artemis Alpha. But in the second half of the year in particular, it's been hit by a slide in the Fraser share price, the McHattie thing. And that's really knocked its NAV. We'll just have to see whether that recovers in 2025. So looking now at the equity income funds, the winner here is Temple Bar, again, which plays this whole value story. They've saying that the UK economy might not be doing very well, but actually the returns you're getting from people doing buybacks, the takeovers that we've seen in the sector as foreign investors come in and try and take advantage of low UK valuations, that's been really helping to drive returns. It was encouraging to see a pick up in returns from Diverse Income Trust, DIVI, which reflects that sort of small cap performance that we were talking about earlier on. But there was a bit of a knock to this in the run-up to the budget, and particularly about the AIM funds, as we'll see in the small cap numbers in a minute. The other interesting thing is that if you had a focus on quality, which is really what those two Aberdeen funds at the bottom are trying to do, that didn't seem to be rewarded. So companies with strong balance sheets and defensible market positions, that sort of stuff, I think they were probably quite fully valued going into this, and they just haven't performed that well over the past year. Now, if we look at the small cap numbers, Top of the heap here is Crystal Amber, which is in wind-up mode. It's shrunk its portfolio down so that its returns are now very much influenced by a couple of large holdings. And in particular, Andrew's talked before on the show about Morphic Medical, which is a medical device company that has been revalued and seems to be doing very well and does hold out the promise of further NAV appreciation, I think, as we go into 2025. But that is a sort of special situation now, really, that we are near the end game for Crystal Amber. Rockwood Strategic, which is one of these companies that follows this private equity style investing in publicly listed companies. That's done extremely well. Richard Staveley continues to win awards all over the place. And again, it's partly driven by bids and things, but it had a couple of strong positions, Filtronic and Funding Circle, that rocketed up earlier in the year, and that drove up its NAV performance. It's quite a concentrated portfolio. Micro caps, again, it depended on how much you had in Spain. So go back again. Depending on how much you had in AIM, but Marten UK Macro Cap did have a fair bit in, and it got knocked. And you can see that's why it's at the bottom of the table, and it's decided to go up the coast. And also down the bottom there, Invesco Perpetual UK Small Companies sacked its manager and appointed Artemis. So now back to Andrew.
Yeah, thank you. Next up is the Asia Pacific, and I think here actually, I'm aware that I haven't really talked very much about this over the year, and sometimes there's just not very much news. We've been focusing so much on the alternative sectors and on these more spicy sectors that actually, where you just have a sector where it's just equity investment, the managers are getting on and doing their jobs and producing reasonable returns, we don't really talk about it. And the returns were pretty decent actually from Asia Pacific, up about 12%. And most of the trusts here, it's a fairly small sector, only 5 trusts, they actually produce quite similar returns over the year, so between 10 and 14% for most of them. The only one that stands out a bit is Pacific Assets Trust, only up 7, so that was a slight laggard here. But actually, if you look at the 5-year record and 10-year record, they're fine on that trust. So I think it was probably just a cyclical positioning element there. So we'll move on actually quite quickly to Asia Pacific Income. And I think this is slightly more interesting. The returns were very similar, excuse me, again, around 12%. And I think what's interesting here is to look specifically at Henderson Far East Income, which again stands out at the bottom of this table. Its returns were lower than the rest of the peer group trusts. And that's been the case for years. I've been writing about this trust. And yet, I think this trust is often very attractive for many investors, superficially anyway, and it trades on a premium rating because it has a very high headline yield of 10.7%. That is the highest yield from any equity investment trust. And so that's a big draw. And people think this is great, I'm getting a lovely income here. But actually, the managers have had to sacrifice so much capital growth to get that income that if you look at the total return, it's quite poor on this trust compared with all of the others in the peer group. So unless you're specifically needing that income flow from the dividends, I wouldn't say that's the trust to have. And actually, of course, you can always take a 4 or 5% dividend yield from something like Schroeder Oriental Income, where the yield's 4.4%. And then you can sell a few shares every year and boost your income that way. So I think that's something to think about. And this is just a note, actually, that you should tend to look beyond those headline yields because they don't always give you the full picture. Okay, next one is Asia Pacific smaller companies, only 3 here. Again, very similar returns, 13%. There's a difference here because 2 of these trusts did really well. Aberdeen Asian Focus and Scottish Oriental smaller companies, both up double digits, mid double digits, very good. Fidelity Asian Values only up 5%, so that's quite a poor return, relatively speaking. And that's because it has a contrarian value approach, which really didn't work in Asia last year. And again, I don't really mind that. it clearly doesn't look good over a year, but the manager has always made it very clear that that is the approach. So if you're buying that trust, that's the approach you're buying. So you know that at the outset. So I think that's fine, and we're always going to have this differential performance. Actually, that trust, again, if you look at the longer term record, has done well. So it could be an interesting contrarian play now. It's on an 8.4% discount, though. I mean, it's a little bit curious that the worst performer in the group is on the narrowest discount here. The other two are on 17%, so there's some value here in this sector, I think. Generally, I prefer these regional funds to these specific country funds, but we'll look at China next, which is, of course, always a fascinating market. And in addition to the table, I put in this 1 year graph here of the Shanghai Stock Exchange performance, because it was such an interesting year. Because actually, for much of the early part of the year, Chinese equities were broadly out of favor, growth was slowing, nobody loved China, and then we had this enormous stimulus reform package that came through in September, and suddenly the market shot up very, very sharply. So we've seen actually the returns from China up 12% for the year. That looks like it's been a lovely balanced picture, much the same as the rest of Asia Pacific, but it was a very lumpy year. And I think if you're looking at the trusts here, there's only 3 left because Aberdeen China merged into Fidelity China Special Situations. I tend to think that Fidelity Trust is the one to look at as a default because it's much bigger than the other two. So if you are looking for a trust of scale, then I think that's the one to have. And again, there's not too much over 1 year to separate these ones, but the Fidelity Trust did put in a decent showing actually with a 15% return. So it's quite interesting. I think it's easy to pillory China, but actually the returns were pretty decent last year. Generally speaking, investors have preferred India because that I think is a higher growth market. It's seen as more entrepreneurial, more reliable for returns perhaps, but it is highly valued. So there's always this tension, I think, when we're considering in India. On the one hand, you've got this potential for excellent returns, but you're really paying up for it. I mean, Indian markets are valued at roughly the same level as the US markets if you look at PE ratios. And of course, we know the US markets are very highly valued. So I think it's a high risk, high return market, this one. And I'm not sure which way it's going to go over the coming 12 months. But the trust in this sector generally did well last year, excellent return of 18.7%. And a very good return again from Ashoka India equity, up 23%. I think this is in many ways the go-to trust in the sector. It was slightly beaten by Aberdeen New India last year, but the track record so far, and it's only a 3-year one, not a 5-year one, for Ashoka India equity is hard to beat, I think. The only thing I would say about that is that you're going to have to pay up for it. There's no big discount on that trust because it's recognised as being a high quality trust in the market. Just before I leave this, at the other end of the table there, JP Morgan Indian, the return here was half last year of the Ashoka India equity return, and it's been a poor trust for quite some time, failing to beat its benchmark. I think it's the writing may be on the wall for this trust. It has a conditional tender offer coming up later in the year. I think it's in the autumn, for 25% of its equity. And my feeling is that if the performance has not improved by that point, then not only will you see that taken up in full, but you could potentially see at that point a trigger for something else to happen. The shares are on a discount of 17% there, so I'd say it's speculative, but if you are feeling that something's going to happen with that trust, then you've got a potential uplift maybe built in there.
Great. I think now we're just going to have a quick look at Vietnam and Korea. So Vietnam actually, it wasn't a great year for Vietnam, and you can see that in the numbers I put there on the side. So actually the market only lost you money, 4.3%, and the Korean market did even worse. So all of these trusts actually outperformed, and I actually did reasonably well. But our favourite for a long time in this sector has been Vietnam Holding. We know we've written about that quite a lot, and its numbers are well ahead of all the others. It's just a shame it's too small, really, and it should be growing. And he's actually issuing shares now, and I'd really like it to do that more aggressively if we can. Weiss Korea, it's disappointing. I do quite like the strategy, but the managers say, actually quite unusually, they came out and said they lost faith in the fact that it's going to perform. So it seems quite likely that fund will wind up. So that's Vietnam and Korea for you. Next we have Europe. Now, Europe was really a terrible place to be. It wasn't just that the economy was struggling. There was also a lot of political upset, particularly like around something like the French elections, for example, which knocked confidence in the markets, and you saw quite a big pullback when that French election result came out. Small cap underperformed here, but actually, I'm talking about the indices, in terms of the trusts, the small cap funds marginally beat the large cap ones. Nothing really stands out in terms of amazing performance. Obviously, the JP Morgan fund did reasonably well. The Henderson European merger seems to have been quite well received, and I'm quite pleased about that. So there were two reasonably good funds, actually, Henderson European Focus and Henderson Euro Trust. So knocking them together makes perfect sense. And then the Bailey Gifford fund is yet to perk up, but hopefully it will join its brethren in 2025 back up towards the top of the leader table. In terms of the small cap stuff, the laggard here is still European assets. European Smaller Companies Trust is one of those that's been targeted by Saba. It had a more difficult year. The numbers aren't enormous, in terms of the underperformance, but it wasn't necessarily more difficult. And it's going to be interesting to see what happens with that one. I think Saba might lose all of these votes, but some of them might be more touch and go. We'll have to wait and see. Next we have
Japan. Yes. Japan was tipped actually at the start of the year by quite a lot of people. It was quite a widely loved market, a lot of optimism about it, and it did okay actually, up 12.7% here for the trust involved. Now, one thing I'd like to just talk about here is that if you look at the performance of the Nikkei 225 index, it was up 19.9% over the year, and the Topix was up 17%. So it looks as though investment trusts really underperformed. But actually, the explanation for that is that they are delivering in sterling, and those headline returns are in yen. And actually, the currency was a headwind yet again last year. We did think it might turn around and become a tailwind, and I think that's possible actually in the coming year. But at the present time, the yen has been so weak that that's really eaten into the returns in sterling. Nevertheless, they weren't bad overall. And what was pleasing here was that two of to my mind, bellwether trusts of the sector did quite well. So JP Morgan Japanese is the biggest. That's top of the pile here with a return of nearly 20%. And Schroeder Japan Trust, which I've recommended actually, and I think that's a generally good all-cap trust. That also did very well actually with a return of 17.8%. So I was pleased to see that. At the other end of the table, you've got Fidelity Japan Trust. Now, there's an irony here. I mean, that really did do badly. It was down 4%. And the irony here is that I just talked about Fidelity Asian values and its value approach lagging the market. In this case, Fidelity Japan has a growth approach, and that lagged the market. So these two trusts have just found themselves in the wrong spots. So the growth approach hasn't really worked in Japan because it's not really been driven by growth stocks. And actually, if we go to the next slide, we'll see this with the Japanese smaller companies as well, where Bailey Gifford Shin Nippon is a horrible underperformer. Again, this is obviously very much growth oriented. Last year, it lost 10% of its NAV, which is dreadful when you look at the comparators here, because actually the two other trusts here, AVI Japan Opportunity and Nippon Active Value Fund both did very well. And they are both targeted on corporate reform as well as investing in smaller companies. And that's been working well, actually. I think that really does make good sense. It's a good narrative. And poor old Baillie Gifford Shin Nippon has been awful. And so we're still waiting for this growth pickup to occur in Japan. And it may come, because actually I've been around for long enough that I remember Baillie Gifford Shin Nippon being a tremendous trust, which outperformed for years and was an obvious go-to trust. And it's had a terrible time actually for a few years now. So again, I think if you're a bold contrarian investor, you might think about that one on a discount of 17%, but it may be too soon. I may have said that 6 months ago, and it really hasn't been working at all well for Baillie Gifford here. So let's move along to North America now. And North America, of course, has been the best equity sector of them all. And the average return here from the investment trust is 17.7%. And if you remember at the top of the program, we talked about the S&P rising by 23.8%. So there has been a bit of an underperformance here, not explained by the currency. But I think it's okay because here again, the market indices were driven by a very narrow, small group of companies. And you don't really want to have an investment trust with that level of concentration. So if you're going to have a diversified portfolio here, I think you are going to underperform a little bit in these market conditions. But there were some excellent performances here, and I'm pleased to say Baillie Gifford actually were top of the pile here. So 33% return from Baillie Gifford US growth. And what's interesting here as well is that the NAV total return was 33%, but if you look across the columns here to the share price return, it was actually 56%, which I think made Baillie Gifford US growth the third best performer across the entire investment trust sector over the year, because it was re-rated as Baillie Gifford's growth style came back into favour. So that's excellent. I'll also note here JP Morgan American, which has been a fantastic trust actually for a long time. They have changed their managers here. Actually, both of their lead managers retired and have changed. So it's really good to see that still delivering these excellent returns. So 30% last year, really, really good. That's been a core recommendation for me for a long time. And I think it's carrying on as being an excellent performer. The tables here actually don't show any figures for Canadian General Investments or Pershing Square, unfortunately. So, but they were somewhere in the middle of the pack anyway. So smaller companies in North America, as we would expect, they underperformed their larger counterparts. Again, the market was very much driven by these huge companies, but up 9%, that's okay. I don't have too much to say here, except that these two trusts had a slightly different performance. The JP Morgan one was definitely ahead of Brown Advisory, and actually that's true over all of these periods. So that definitely has the better track record of the two. That was all I had to say about that one, but we're coming on to a really exciting one now. A terrible one, really awful. This is the worst one we'll look at. Latin America, there's only one trust left, BlackRock Latin American. What a torrid year it had. I mean, you can see that I put in this 12-month share price chart just to show you that it was unrelenting. It was down all year long. And actually the trust did quite badly. It was the reference market index here was down about 25%. So partly gearing, partly a concentration in financials and materials really undid it for this trust. It was a terrible performer. And it's always been volatile. And of course, it wasn't helped by the election of Trump, because that caused a lot of concern about the trade prospects for Mexico in particular, and also Brazil. And this trust really is a Brazil and Mexico trust. That's where all of the assets are. So it's had a tough year. And I dare say those concerns about tariffs are going to continue. But if there is some clarification on those, and maybe they're not quite as bad as expected, then this trust could bounce back. I mean, I think if you look at these figures now, you just think, well, I'm going to leave that alone. And that's maybe the best answer. But historically, the time to buy this trust has been when it had a terrible patch and everybody hates it. It actually it does generally pay to buy in the dark days. So again, if you're a contrarian investor, don't rule it out.
Cool. So onto the specialist equity sectors now. I'm conscious there are some questions coming through, but we'll get to those at the end. I think it's probably easier. So first of these is biotech and healthcare, and there was a sort of quite volatile year, really. We did see a recovery in biotech, but that sort of petered out a little bit. Generally, the healthcare stocks and pharma stocks, big pharma stocks, outperform biotech over the year. So it really depends on where your portfolio is positioned. But a lot of it, as always in the sector, comes down to stock picking. And it just worked out that International Biotech, I've always really rated those two managers, did a better job this year of picking stocks than the Biotech Growth Trust did, for example, which is probably the closest comparator. Bellevue Healthcare struggled again, and investors have punished that because it holds a sort of regular exit opportunity, and there was a bit of a rush for the exit at the last one, so that fund's shrunk quite a lot this year. But we do like this sector, and we do think it's got good prospects, and you'll know that if you want to read more about it, we've got a note on Polar Cap Global Healthcare that's relatively recent, I think. So that's healthcare, and then moving on, mining now. Now again, it was a tricky sector to make a lot of money in. Really, the only commodity that did amazingly well was gold, which just kept hitting new highs through the year. Petered out again towards the end of the year, but that played very well, obviously, for the gold and prospect precious metals, which is orientated towards this sector, and most of its assets in gold miners, and it's going to have a welcome uplift in its NAV after a tricky period beforehand. It's actually taken a long while for the gold price rise to feature through into that NAV, but it is starting to work now, and hopefully that will keep going. For the others, sorry, can I go back again? For the others, it was really the lack of demand from China that was weighing on the sector, but also there was a sell-off on the uranium price after that had been very, very strong in 2023, and that held back Geiger Counter, and I think that's partly related to prospect of new supply coming on, which is always a problem here. It was disappointing to see BlackRock World Mining down the bottom of this table, and I think that's just a matter of stock selection, really. But that's actually, that underperformance is not very wide relative to where the index was, the wider index. So moving on now. So environmental, this sector is about to shrink dramatically, so we are going to only have one trust left here, because both Menharden and Jupiter Green announced towards the end of the year that they're going to wind up. Menharden's numbers look much better than the others, but that's really because it's been investing in things like Microsoft and Amazon and stuff, things that you wouldn't normally reckon to be environmental stocks, but on the basis of they're resource efficient. Jupiter Green and Impacts are far more direct comparators, really. You can see that the Impacts has done much better here, but it has been a bit of a struggle. For the infrastructure securities trust, Ecofin Global and Premier Miton Global Renewables, the direction of interest rates has been a big influence on the sector here. Although, definitely, if you talk to the managers of these funds, they would argue that they're not bond proxies, and nevertheless the share prices do tend to move with where interest rates are. So falling interest rates should have been good news, but particularly around the election of Trump, renewals have been hit, as we'll see with the sector in a second, and because there's gearing within the Premier Miton structure, that really weighed in its NAV, and I do think we're starting to come. I mean, it's been a number of dramatic recoveries in the past, but I think we are starting to question whether this fund can keep going post its repayment of its 0 dividend preference shares in November this year. So that's that. Next we have financials, and you'll have seen that I've been writing some stuff. Sorry, go back in. Public financials, banks in particular, are really set fair in this kind of market. So although rates have come down a bit, they do seem to be going to be higher for longer, and so the bank margins are going to be still quite good. And if Trump follows through with some of his promises to rip up regulation in the States, that will be really quite helpful in terms of dividends and buybacks and stuff for banks too. So I think that sector could carry on going. Augmentum hasn't kept pace with the public cap financials, partly because it's invested in unlisteds, but partly because it had a write down in a couple of reasonably large holdings, Grover and Fairwell. In the tech funds, Andrew's already talked about the phenomenal performance of Manchester and London. Sure Ventures is a very different beast. It's tiny, and it has some investments in some kind of esoteric things, and it got a takeover in one of its stocks, and that drove that NAV up. But the two big mainstream technology funds, much less in terms of the returns there. There's not a lot to pick between them, although Allianz Technology just pipped it, and that's really down to their AI mega cap type exposure, which has been driving the numbers through. So,
all right. Yes, certainly tech was a fabulous place to be. We'll move on to something a bit more esoteric now and dive into the debt markets, which I think may be of slightly less interest to some people, but actually if you're an income investor, there's some great opportunities here with some very high dividend yields. So first of all, direct lending, and I think here biopharma credit stands out. This is quite a big trust. It's widely regarded as being a high quality trust, good manager. He explains what he does very well. It's a very specific remit that he has. He invests in the debt. He lends money to pharmaceutical stocks, and very, very strong track record. Last year, the NAV return was 12.8%. And I think sometimes this trust is rather underestimated because people look at the dividend yield in the performance tables that we take for granted have accurate figures. And actually, those rather understate the total dividends because there's a regular dividend paid, but also a special dividend here is paid actually quite frequently, and that's not included in those figures. So the yield you'll see actually underestimates the returns here. And they've been very good. You see over 5 years here, it's an 11% a year return. And I think this is a very good, reliable trust. For a long time, it was able to boast that it had never had a default. And then actually it did have one, which was a company, I think, called Lumira DX. But it actually recovered nearly all of the money back. And in fact, there was one little bit about outstanding recovery there, which I think, I'm not sure quite how that played out. It may have got everything back in the end. But anyway, it didn't have a problem with it. Its process worked well to recover. So actually, again, I think a very, very good trust worth thinking about. But this trust, this sector is going to shrink because 3 of these are disappearing actually. GCP asset-backed income is in the process of winding up. Same for Riverstone Credit Opportunities. And then there's the one at the bottom, which is a terrible story actually, VPC Specialty Lending. It had its moments in the sun, and actually during the days of the expansion of SPACs in the US, it did really well where it had equity kickers to go along with its debt, and actually it really moved up, but sadly now those are all losing value, and that's again winding up. But each time it brings out an announcement, it seems to have another woeful story of the NAV going down. So that's a winding up that hasn't worked out well for shareholders. We'll have to see what happens with that one. So we'll move on to the next debt sector, structured finance. And this is really talking about things like CLOs as well as bonds, and actually quite a lot of esoteric instruments that I think are difficult to understand. And I think we always say it's a mantra of the industry, isn't it, that you should never invest in something you can't understand. And I think that's broadly true. But I must say I've struggled with these a bit. But the returns have been good. And so, I think it's tempting actually to look at them and really spend a bit of time trying to dig into these to understand them. Because the returns overall last year, 14%, and you can see they were all actually quite good. The bottom one, Blackstone, is winding up. Actually, that's going to complete this month, so you'll get your money back on that one. But I do own one or two of these myself because the yields are tremendous. On Fair Oaks income, I think the yield is about 15%, and it did return 15.5% last year. And so, again, these reward a bit of research if you can get your head around them. They've been good trusts and actually quite reliable over time. The next sector is loans and bonds. Again, very decent returns last year, 12%. And we've got CVC income and growth at the top of the pile there with a very strong return of 22%. This was generally a good place to be. The NB distressed debts was a bit mixed at the bottom, but apart from that, actually, returns were very good, mainly double digit. And one trust I'll just mention here, the one in second spot here with a return of nearly 18% last year, is 24 Select Monthly Income. Now, I think that's the only investment trust that offers you a monthly dividend payment. And that is something we do see in the ETF industry, but we don't really see it very much in the investment trust sector. We tend to be quarterly. So if you'd like the idea of a monthly dividend payment falling into your account, then that's one to think about. And actually, it's been a very good trust. The headline yield is 8.6%. The shares are trading on a premium, so the trust is expanding, and it's been a very good trust. So something to think about if that idea appeals to you. There's just one more debt sector to come, which is property. This one again is shrinking because Starwood European and ICG Longbow are both disappearing. There's a couple of very small trusts here as well. So really, I think the one to look at is the one at the top of the list, Real Estate Credit Investments, a return over the last year of 9.3%. And it's been a good trust, this one. I own it actually. It's a reliable performer. Again, it's managed to avoid defaults on the whole. It has a very attractive headline yield here of 9.7%, but it's also, I think, a bit surprisingly on a discount of 14.5%. So my feeling is there's some value there. Their managers as well do speak of the potential now to increase the yields they're getting on the current deals. So again, I think quite an interesting trust.
Cool. So now we have growth capital, which the NAVs didn't move an awful lot, as you can see there, but the share prices definitely did. We've had quite a big bounce in some of those. Lots of discount narrowing. That doesn't mean that these things are trading in their asset value. A lot of these things are still on quite big discounts, but it has been sort of a bit of sign of life anyway, which is good news. I suppose, as with some of the other Baileyford funds, the part of the reason for the NAV rise here with Schiehallion was down to SpaceX, because that's going to be revalued soon. I think we haven't quite got the details of what happened to it, but there was going to be some trading at a much higher price in December, and that obviously is going to increase the size of that stake within the Schiehallion fund, which is part of the reason for the NAV rise. So that's been partly reflected in there. Peters Hill is an unusual fund, and one that I think we need to do a bit more work on. But it invests in asset managers, and it's made a couple of fairly sizable sales from its portfolio during the year, and that's sort of uplifted its NAV. Chrysalis is one of the ones where the share price has done quite well, but the NAV's been quite flat. Although it's had some good news for some of the disposals that it's been making, it did have to write down the value of its WeFox, which is its German insurance company, and maybe we'll have to wait and see. That will be offset this month or next month by a jump in the value of Klarna as that IPO. So we're going to have to wait and see what happens with that. At the bottom of the list here, as it has been for some time, is the old Woodford Patient Capital, Schroeder Capital Global Innovation. It does feel as though the board have given up on it. They've pulled forward the continuation vote, and I imagine that this is going to be just put into wind-up mode now. But it will take some time to sell off that portfolio. So, next, I think we have back to Andrew.
Yes, hedge funds. Again, probably not something that would appeal to absolutely everybody, but there's an interesting case here, I think, to talk about. The returns were good last year, and look at the one at the top here, Third Point Investors, up 28.6%. That's a tremendous return, and this is the trust I'd like to talk about here. This is a bit like Pershing Square to my mind, because it's run by a charismatic individual who's very much in charge here. He makes the decisions, and it is based on US equities. Is effectively a long-short hedge fund based on US equities. So it's had quite a lot of those big US growth stocks, the tech stocks that have done well, hence that return. And it's in an interesting position now because the shares are trading on quite a wide discount of 22%. And this has been the case for quite some time. And the board has been trying to address this. So back in the spring of last year, the trust tried a tender offer for 25% of its shares. It hoped that that would narrow the discount. It didn't. It shrunk its trust by 25%, but nothing happened to the discount at all. And so the board then formed a strategic review committee to have a look at this. And they said they were going to report by the end of 2024. Now, instead of that, in December, they said, well, actually, we're going to delay this now until April. So we'll tell you in early April exactly what we're thinking. But the reason for the delay is that we're conducting due diligence into one interesting strategic option. That's what they said. And I don't know what that means, but I do think there's a real possibility of change here. And I think, the board is really quite determined here to try to deal with that discount. So here you've got a very strong performing trust on a wide discount where they said they're going to do something about it. So to me, that looks like a decent combination, actually. And I don't know what's going to happen. It could be that actually nothing comes of the strategic review. So that's a bit speculative. But in the meantime, if you're exposed to, good underlying companies, then maybe that's one to think about. It is traded in US dollars, but I know you can buy it on the mainstream platforms because I've done so. There we are. I'll hand over to you again, James.
Thank you. So, infrastructure, most of these funds just sort of potted along really and doing what they're supposed to do. But it was interesting that digital infrastructure, although we've had the disaster of Digital 9, it actually has been a good place to invest. It just shows you how badly that portfolio was put together for Digital 9. The Accordion's actually done very well, and it's the best performing trust here. And then Pantheon Infrastructure, which ranks second, it's got quite a chunk of its portfolio in digital too. And these things are working. Because there's a very obvious demand for more broadband, more wireless infrastructure, more 5G masts, all the things that they are investing in, more data centers particularly. So yeah, this thing is still working, and I think it will continue to do so. So you've seen a bit of a narrowing of Accordion's discount, but I think that might have further to go. Pantheon, the discount has narrowed very slightly, but I think that should have an awful long way to go too. And then Digital 9, very disappointing. We've written a bit more about that today because if you remember, we tried to pick some winners for 2024 at the beginning of the year, and David Johnson here picked it as one of his ones, and it didn't quite work out. But there's an explanation of that in the QD view that will come out after this program. GCP on there, not very exciting in terms of the NAV returns, but there's been a lot of hints that it is working quite hard on selling a chunk of its portfolio, and when it does that, it's going to have money to fund buybacks. So I think that discount's way too wide, and that's one that I've been buying actually. Next, we have leasing. Now this is actually one of the stars of the year, really, and it all came down to Emirates deciding that it wanted to buy Doric Nimrod Air 2's remaining A380s. So it's got these planes that were leased for I think 13 years in the end, and the leases have come to the end of their life. This fund is being wound up, but the value of the planes had been written down, and it was quite good news to see that Emirates wanted to buy them. It's helped that the Boeing's woes mean that it's not got much of a competing product out there for the airlines to buy. The shipping funds did very well too. You can see there's actually still quite decent numbers in there, high teens. Partly on the back of problems within the Red Sea that meant that more ships were stuck at sea for longer, and generally the sort of downturn that we've seen in trade means that people haven't been investing in building new ships, so those things have been doing quite well too. Unfortunately, we're going to lose Taylor Maritime, which is one of the ones I quite like, but it's decided to become a sort of real company, if you like. And then at the bottom there, we've got another one of the plane leasing funds, but it didn't have so many A380s. That's a different issue than it's experienced, so that's why it's down at the bottom. So next we have renewables, I think. No, private equity first, sorry. Now, private equity, although it's relatively solid, there haven't been an awful lot of exits this year, and it needs the exits because that's really what drives the NAVs up. So the underlying companies, for the most part, seem to be doing very well, and recording higher profits and higher margins and higher sales and all this sort of stuff, which is all great. But until you get the exits, you don't really see the markup in the NAV, and it's something we keep banging on about. These NAVs are conservative. That's the way that they do them. So I think that means there's some sort of latent value here that means they could do better this year, but we're going to have to wait and see. Just looking at the winners and losers, 3i, it's still all about Action, this retail group in Europe, that continues to do relatively well, and continues to drive its NAV. It's a bit of a sort of one-trick pony now, though. If anything ever went wrong with Action, then 3i would become a cropper, and so I think you need to bear that in mind if you're thinking about putting it in your portfolio. Symphony's in wound down. It's been a bit all over the place, but I think it should make some disposals, and that's what made the NAV go up. And at the other end of the table, you've got EP Special Opportunities, which is a very concentrated portfolio, and it sort of swings around at the back of one particular holding in particular. And NMS Capital, where it had to write down the value of two investments. One is a Romanian energy play called Dacian, and the other one is a property development company that was building something in Mayfair that more or less went bust, I think. So, yeah, a long way down. But it's tiny anyway, that fund now. Moving on. I think we do have renewable energy. There we go. Now, I'm pretty sure that this 10 NAV number here at the top is wrong. We are subject to Morningstar in terms of these tables, and there's not much we can do about that. There is a wind down. It does seem to be progressing relatively well. It will get done soon, but I don't think the NAV actually went up 21%. But the encouraging thing underneath that is the next one done, STCL Energy Efficiency Income, which has been really hit hard. You can see here the contrast between the NAV returns and the share price returns for most of these. the discounts widened out quite a lot further, and they were already quite wide at the beginning of the year, and we thought there'd be a sort of rebound, but it hasn't happened. So I think this one is actually quite interesting. Although it's got a big chunk in America, and that's one of the reasons why people are worried about it, it's not really massively invested in the sort of renewable energy bit that Trump is targeting. It's got some sort of more traditional energy investments too, and I think those will hold up relatively well. And then you've got Greencoat did okay, but down the other end of the table, that's really dominated by the battery funds, which have been a sort of saga through the year of struggling to monetize their battery investments, that they've just not been used as energy storage by the national grid, and that seems to be changing and seems to be improving, but they've had to write down the value of some of these, and that's been affecting the NAVs. And Harmony is the one that decided, well, we're going to wind up our portfolio, and it has sort of dropped some very heavy hints that a transaction is about to be announced, but we don't yet know what the price will be. You could see a big jump in that share price if it comes in anywhere near NAV, but it's a gamble. And just to prove how dangerous it is to gamble in these things, Ecofin US Renewables has been wound down, and we thought that would be a relatively straightforward process. But when they sold a chunk of the portfolio towards the end of the year, the value that they got for it was an awful long way south of where they'd been valuing it, and that hit that NAV, and that's been reflected in its share price. So,
yeah, I think next up, UK commercial property. This is the broad sector here, which has shrunk a great deal. You know, we've seen more corporate action in the REIT sector, I think, than any other. Lots of trusts disappearing, being taken over, typically at some kind of discount to NAV, but nevertheless, it's been a pretty decent process for shareholders on the whole, because they have seen an uplift in share prices. But nevertheless, this is the rump of what's left, and the returns were pretty modest overall last year, but extremely mixed. I mean, actually, I'm not sure the figures here are very useful, because Aberdeen property income, it's showing a loss of 70%. I mean, that's nonsense. That's just because it's just given the money back. So I would ignore that one. But nevertheless, there's quite a dispersion here, which is probably what we'd expect because of the different sectors involved. But I think it's fantastic, actually, to see AEW UK REIT at the top yet again. I mean, they've maintained that position actually for several years. And I must say, in my December newsletter, I always look at the awards ceremonies and exactly which awards have been given to which property, to which trusts across all of the sectors. And AEW UK REIT just seems to win every year. I mean, it's been fantastic. And the return last year was way beyond anybody else, 13.9%. If you look at the 5-year NAV return, it's 10.5%. Really excellent. The management here seems just very strong. They're able to really work their portfolio. It's a lot of work involved in renegotiating leases, refurbishing, making sure the rents go up, and they really do a good job there. So I think if you're looking for a trust in the sector, that's one to think about. It has been consistent over such a long time. At the other end of the spectrum, regional REIT had a really appalling year. You can see the 1-year NAV returns down 57%. Now that's really because it was forced into a highly dilutive rights issue in the summer, which did raise £110.5 million. So it got it out of its hole, but at a considerable cost to the NAV. But that has managed to get it over the hump. I mean, it had a problem with getting the refinancing, because it had a bond expiring and banks didn't really want to lend it any more money. So the equity raise sorted that out, and it's given that trust now, I think, sufficient flexibility and wiggle room to give it time to sort itself out. But of course, it's still got to persuade people that its office portfolio is worth backing, and that's a different question entirely. But I think it's going to be an interesting year ahead, actually, for UK commercial property. I think nearly everybody I speak to in the sector, including some really seasoned property professionals who are used to the cyclicality of it, they do say that the sector is past its worst point now. And if we do see UK interest rates really coming down next year, I think that's going to help quite a lot. So potentially brighter times ahead.
I think I completely agree with you, and I've been saying this for a while that it's going to turn, but unfortunately half of these funds are wound up already. They're going to be taken out, or so our choice is more limited than it was. There we go. Just to wrap up on the property side, then we move on to the next one. There we go. So healthcare has been a nice solid place to be, and it's partly because the rents are linked to inflation. And so that means that feeds through into property values, and that's obviously been quite good news. The logistics side of things, the demand's holding up. Prices, the yields that they're valued on have been rising slightly, and we're expected to where interest rates have been. So that's held back returns, but nevertheless, those numbers are now positive, which is good to see, and I think that just reflects the turn that we've just been talking about that's starting to come through. And then on the sort of residential ones, the winner here is PRS REIT. And unfortunately, I think this is actually quite a decent trust, but it does seem likely to disappear. Really because it had this fallout between the board and the shareholders, where the board decided to extend the manager's notice period for no good reason. And upset a lot of shareholders who were rather hoping that they'd focus on narrowing the discount instead. They've new directors have gone in there, and it does seem likely to me that it's going to get taken out, but we'll just have to wait and see. Social Housing REIT, which was Triple Point, has got a new manager, which is why the name changed. Those numbers are okay, but it was slightly hit by some write-down valuations of the portfolio. But nevertheless, that's on a very big discount, and I think that could rally. And then the real dog, although it looks like it's income fund, and that is a pretty terrible fund, the real dog is Home REIT. We are still waiting for them to publish up-to-date accounts. It's incredibly frustrating. They've been promising them, really, there's some firm dates in the summer, in September, in the autumn, in Q4. Hasn't happened. We do need to see those soon, but that has now adopted a wind down strategy. So I think that's the lot, if I'm right. So let's quickly. Oh no, not quite. We've got the Property Europe and Rest of the World ones. These are. Really, they're a hangover from the golden period pre the financial crisis when a lot of these things were launched, and some of them are struggling now. Some of them are still quite big though. Schroeder is relatively good within this peer group. The Aberdeen European Logistics Income is winding down. Phoenix Free Deutschland also decided to do the same thing. Global Earth Real Estate is one I'd be wary of generally. It tends to, it issues quite a lot of stock in relation to scrip dividends, so that dilutes your NAV. But also it's seen some yield rising, so values falling on property that it owns as well. And in the sort of rest of the world stuff, most of these things are and deep wind down mode. There's not pretty much left now, but SEBA is still ploughing ahead. This is the Cuban one, and it's doing a pretty good job, but until relations between the US and Cuba improve, which seems very unlikely now that Trump's won the election again, it really won't see a renaissance in this, so it's on an extremely wide discount. So I think that is now the lot. Let's try. I know I'm conscious of time, but let's try and cover some of these questions so that we and maybe if I can put some of the. Andrew, what do you think are the best value trusts to put your money to work in 2025? Where? No, don't have to name names, but
Yeah.
what kind of areas?
Well, that's a very big question, actually. And I tend to have a slightly contrarian mindset. And so I think actually I would look outside of the US, which obviously had a fantastic 2024. But I think actually that increases the risk of 2025 not being quite so good. And so I think actually, the UK has looked perpetually cheap, and I don't know whether that's going to change or not. But actually, I think there's some good value here, some very good trust. So I have a bit of my money in the UK, and then I do think actually that we've been in a rather golden period actually for investment trust investors in certain respects, because there've been this tremendous value on offer from these super wide discounts and the high dividend yields. So actually, some of the areas that are still very much out of favor, like renewables and private equity, um, I'm happy to put my money there and just be patient and wait for those to come through. So, I think there's some very, very good value about it. It's a great time to be an investment trust investor.
I think I completely agree with that, and definitely things that I've been buying is exactly that: renewables and private equity. Yeah, some proper bargains there. Um, there's a specific question about Ruffer. So maybe if we put up the flexible investment slide, is that possible? Um, really, the question was asking: did Ruffer lose money in 2024, despite aiming to produce consistently positive returns? And how often does this happen? Yeah, we're loading slides. So right the way towards the beginning, I think, flexible investment. And then you can see it is when the slide comes up, it is down the bottom of the table. And yeah, I think that is true. It did actually lose money. I mean, with these funds that Ruffer capital gearing personal assets that are aiming to produce positive returns every year, not doing so is quite bad news. And you can definitely see that over the last 3 years with these funds, the figures are quite low, but at least they are slightly positive. They're all for very different reasons. So capital gearing, it's because it's got quite a lot of investment companies, and those discounts widened out, and as we know, that's hit its returns. Ruffer, it's really just down to the mix of assets that it's chosen to invest in, and it hasn't quite worked. With this one, my favourite tends to be personal assets. Just has been for a while, but similar sort of approach, but a slightly more risk is RIT Capital, and there the numbers are way higher. It really has perked up this year, and I think it could have further to go. So that's that one. Andrew, would you invest in Europe for dividends?
Not especially, no. I mean, I think if I'm a dividend investor, that's not my first port of call. I think the dividends are okay in Europe, and I think they're actually probably reasonably reliable. So I don't think they're going to be cut. But actually, one interesting thing we saw from the table of European performance is that European assets was at the bottom, and that has a seemingly attractive dividend. I think it's 6 or 7%. But the problem with that is that it's artificially generated, and it's not actually a real dividend yield at all. And again, rather like Henderson Far East Income, if you look at the total returns from that trust over time, they haven't been very good. So yeah, I mean, you could certainly have dividends from Europe as part of your overall portfolio, and you're going to get 3 or 4%, but it's nothing dramatic. There are many more better, I think, dividend yields available elsewhere. But it's a valid point, actually, to make sure that you have a diversified equity portfolio and that you're getting dividends from all over the place. You don't want to have too much concentration. So, yeah, there's no reason not to have European companies for dividends, but they're not the obvious spot, perhaps.
Yeah. I'm going to be paying and ask you to put up the UK equity income slide, if you don't mind, because there's a question about Murray income. And definitely, within Europe, and then obviously we are still in Europe, the UK is where the dividends are, and so that is probably the better option. So, but in that table of UK equity income, Temple Bar was way at the top, but Murray Income and Dunedin Income and Growth were down the bottom. But actually, Aberdeen Equity Income Trust is up there towards the top end of the table, and there is a sort of contrasting approach here. Really, it's down to how much you're focused on traditional value style income investing, which is really what Temple Bar and Aberdeen Equity Income are doing, and how much you're focused on the sort of slightly lower yielding but higher quality stuff, high quality, and that, as I say, hasn't really worked. It may come right, definitely with the UK economy struggling. You'd like to be in some sort of solid companies, but both of the Temple Bar and the Aberdeen Equity Income Managers, they would reinforce the message that the things that they're investing in are actually, although they're sort of relatively boring companies maybe, and maybe they haven't got a huge amount of top line growth, they are quite cash generative, and that cash generation is being used to pay dividends and buy back shares, and that's driving returns, and that can carry on going, I think, in 2025. Cool, thank you for that. One more, just Andrew, just to wrap up, I think. What do you think the biggest risk is that investors face this year?
Yeah, I think you have to look at the big picture here. Actually, it's macroeconomics. I mean, it's easy. I think it's an easy answer to say the biggest risk is Donald Trump, but I'm not sure that's true actually. Because, I mean, clearly he can be unpredictable, but I think he's very much pro markets, and I don't think he is actually the biggest risk. I think the biggest risk is probably a resurgence of inflation, and if that does happen, then we could see the entire basis of the argument for interest rate cuts being undermined, and that I think will cause major issues throughout the sector. So I'm keeping an eye on inflation. Actually, I think that's something that it's easy to take for granted now that we think inflation has been quashed, but I don't know, it could come back.
Yeah, I agree with you. Thank you very much indeed for your time today, and thank you for everybody that tuned in. We'll be back next week, and we're talking to, I think, Alexander Darwell, who's the manager of European Opportunities Trust. But what we have tried to do, if we look at the sort of upcoming slides, we're trying to talk to some of the managers of the things that have been targeted by Saba. So here we go, sliding through these. We've got the manager of Edinburgh Worldwide in, and we also got Bailey Gifford USA, or Bailey Gifford US Growth rather, coming up too. So they should all be quite interesting, I think. So thank you very much for your time today, and we will see you next week.